Good evening and welcome to the FiTT Show. Financial information for today and tomorrow. I'm Bobby P. Kinzer.
And I'm Thomas Doty.
And yes, we are the FiTT Show, helping our families and friends get their finances in shape. That's why we call it the FiTT Show. So, welcome to people around the country and around the world, especially my friends in London and England and Scotland and Ireland that tune in. They're 5 hours difference and they're really troopers. So, we thank you all for tuning in with us. How are you doing today, Thomas Doty?
Man, I'm happy to be alive. How you doing?
Oh man, if I was any better, man, I probably would want your hand and your foot because you are doing very well, young man. I gotta tell you.
I'm still here. That's half the battle, brother.
Yeah, we still here, and just remember this is the youngest you will ever be.
Yeah.
It's the God's honest truth. So, welcome. Last week's show was Is One Fund Enough? We talked about index funds and just other funds too, not just S&P 500 index fund, but other index funds and other actual investments that you can get in. But it's really makes a lot of sense to have a index fund, especially one like the S&P 500, because it's so simple and you can just put it there and don't look at it and let them manage it for you, which is called passive management, have lower expense ratios, but great returns. And you don't have to be no genius. But today we're going to talk about how to beat inflation and build wealth. And we've talked about a little bit about inflation before. We talked about wealth, but we want to talk about how those things work together because when you go to the store, when we talk about inflation, it's just the price of goods. And they keep talking about gas and going up. But man, you go to the store, eggs, milk, cereal, a lot of things are going up. So we want to talk about
You know what's funny, Bob? They're saying that one of the reasons the market had a good day today was because the numbers say that inflation has cooled, which I ain't seen it. I think gas is still really high.
Yeah.
So it's
everything.
I don't know where they're getting those numbers from, and I truly do not trust them.
They're just straight out lying because
Oh, come on, that administration wouldn't lie. Come on
now. Of course not. But and that's what I'm saying, that the people know and you all know. And we're glad that y'all tuning in the show because the name of the game is you all. You only know what you know. And what me and Dope, like to offer you is just some alternatives and some information. Knowledge, they say, is power, but really knowledge is just information. But action is power. So we hope, you take action with some of the things that we some of the tips that we give you. And just want to make sure that you click on to the like button and the heart button, just get the administrative things out the way in case you forgot, because that helps us reach more people. That's how the algorithms work. Then we also like for you to put comments in the comment box because that's exponential growth for us to reach people when you go out there and put a comment. But, if you have an opinion, put it in there about something we're talking about, or you have a question about something we're talking about, or you have something that you come across you like to share. And the fourth thing is, if you have a theme for us to cover in the show, and it's okay if we did it before, we're making a round robin on some of the things we taught before because this is our 247th show, Dope.
That's a bunch, buddy.
Is that 4 years or 5 years, Dope? I always forget.
How many? I think it's 4.
I think it's 4, right. So we've been around and we plan to keep on doing this. As long as y'all keep tuning in, we're going to keep doing this. So we really thank you. But for some of y'all, if this is your first time, we always start at the top of the show with the stock market update. And just make sure people understand this. When Donald Trump and them are talking about, the things they doing that is helping, no, it has some effect, but no, the market, the stock market, everybody's not in the stock market. But But we got information for you if you do.
And we think you should, because
And that's all we should.
our folks are making money.
We ain't saying, you got to do what we do. But what we are saying is, oh, yeah, I was worried, though. It was taking a little while to work there.
Hey, you've been on the road. I didn't even think about it now.
Don't curse me. Don't curse.
I didn't even think about it now.
Here we go, Doe. Let's start from the top, y'all.
Okie dokie. And then it's been a pretty quiet week this past week. The S&P's up slightly, 1%. NASDAQ's up almost 2%. Microsoft's going down a little bit last week. And some of that's just profit taking. I mean, if you look, March 31st, if you look back at March 31st, you say, hey, what the heck was Microsoft doing then? March 31st, Microsoft was at about 370. Okay, 370 bucks. It's up to 497 now. That's a pretty hefty increase. And so a lot of people are just taking profits there. Apple has started to slide a little bit, but we talked about that last weekend, and that was because the kind of downcast guidance they gave for the rest of the year. They're having some supply chain issues. So that's why Apple's down. NVIDIA's had a nice little run. It was up 6 points, almost 3%. Google's taken a little hit. And again, that's another one that they're having some issues, just as Microsoft, and we've talked about this before, with the amount of money they're spending on AI, even though the stock has done really, really well. That's another one that if you look at Google, go back a year ago, last August, it was at 212, okay? So it's had a pretty nice run from 212 a year ago, and now it's 357. So I'm sorry, 344. So that's still a pretty good run, but there's been some kinks in the armor as far as the amount of money they're spending. They actually had a negative cash flow because they're spending so much money on capital expenditures for AI. And I think it's up around 200 billion for the year. It's just goo gobs of money they're spending. It's a race. Everybody wants to win this AI race, and everybody's spending a lot of money to do it. And some of the investors are getting a little nervous about just the magnitude of money being spent. My Pfizer went up $1, and my Boston Scientific went up 3. Hopefully that's the Boston Scientific is going to start to make a move and start moving in the right direction. And it has for the last couple of weeks.
Okay, Doug, can you share with us again what is Boston Scientific? What is that?
It's a company that sells medical devices, and it sells one that's near and dear to both Bob and myself, because we both have a condition called atrial fibrillation, where your heart can pretty much, because of electronic activity, go out of rhythm and not beat with the constant beat that most people have. Our hearts will actually flutter and not beat. And what happens, the blood pools, instead of just pumping out of the heart, it just kind of pools. And whenever blood pools, there's a likelihood of a clot occurring. So what Boston Scientific does, they make a device that is inserted in your chest, and it kind of mitigates the possibility of blood pooling in your heart. And they had a few issues getting it out, and but now I think all the information out on it is good, and hopefully it's going to start to take off. They have some other medical devices that they also sell, but I just think this is one that may do well down the road. And so that's what Boston Scientific is, Bob. And this again, as I said last week, I'm still pretty nervous about the stock market. I'm not selling anything, obviously. I'm still holding on to the stocks I have. And if you look at where they are now, I mean, except for Pfizer and Boston Scientific, all these stocks I got in a long time ago and have pretty sizable capital gains, and probably have no intentions of selling those anytime soon, or maybe anytime ever. But So I'm not going to sell those. If I sell anything, it would be Pfizer or Boston Scientific because I'm going to keep those four big boys there: Google, Nvidia, Apple, and Microsoft. But I'm just real nervous about where things are, and and I hate to be a Chicken Little, the sky's falling. But if you look down the road, and what do you see? Well, you see this huge deficit that's being created. You see Social Security being running out of money probably in 2031. You see taxes being the lowest there will ever be, federal taxes, the lowest there will ever be in our lifetime. Taxes will definitely not get any lower. They probably will get higher. And so things just don't look don't look good to me. And again, I'm not going to get political. We're not going to get political. But the scary part is, even if you get a regime change, this isn't something that's going to be fixed in a 2, 3, 4, 5 year period. So I'm just not optimistic, but I will, if I was younger, I would still continue to invest because whatever happens, eventually we're going to come out of it, eventually. But and as Bob said at the beginning of the show, we believe in investing in stocks. It's just too many positives to investing in stocks as far as growth. We always talk about the tax favorability that you get from investing, as far as offsetting your losses, capital gain percentages being much lower than ordinary rates. But things are going to be shaky for a while, folks. That's my take on it.
Yeah, Dope, that's a very very good take on it, you all. But that, like we always say, Dope shared his stocks with you, and we're not telling you to invest in those stocks.
Oh, definitely not, because I got into Microsoft at like 200. I got into Apple at 100 something. I got in Google at like 120, and of course I got in Nvidia at 17. So no, I wouldn't buy them at these prices.
Right.
And but before I forget, Bob, there's another scam out here. And I always try to keep. I don't want to see anybody that listens to us get scammed. And this is we always talk about ATMs, and we've told you several times about the skimmers that they put on top of the keyboard to record your information, right? Well, not only that, now they have a device that they actually slide into the machine where you slide your card in. And that machine has a camera on it and records your data, and they pick that up the minute you put your information in, and then they go to town on your debit card. So
wow.
Couple things you can do, and they call it shimming. The other one is called skimming. This is called shimming. And the two things I'd recommend you do: if you're going to take money out of an ATM, go inside the bank or inside the location, because typically they're going to have cameras. And I got ready to say crooks aren't stupid, but crooks are smart enough to know that they'll get caught pretty easily if they do it inside and they're manipulating with the machine. Okay. And I actually saw video of them putting on the skimmer. It took less than 20 seconds to put the skimmer on, and it took less than a minute to put the device in the slot. So the two things I want you to do is go inside the bank if you need to take money out of an ATM. And if you notice any issue putting your card in, do not use that ATM machine. Okay? So again, stay on the lookout, stay alert, and don't get took.
And though you know why most people get scammed? Because they're in a hurry or they're in a rush. A lot of people don't want to take the time to go into the brick and mortar. You know what I mean? A lot of people don't want to take the time to look around and see, because like the skimmers, they're not even physically strong. You can hit them and they'll fall right off if they haven't learned how to secure them, real tight. The skimmer, you can just hit it and it'll fall off. But this is a little bit different. This is going inside the slot. So,
Yeah, and yeah,
but,
if
but
you have any kind of trouble, don't use that
yeah,
machine.
but
If you
slow
even
down.
think it, yeah, if you even think it's an issue, go to
Yes.
another ATM machine or go inside the bank and talk to a
And,
teller.
and most scams don't work by people being fast, not being patient. So, thanks. It's amazing how we can almost every other show we got a new scam though. It's just, but
It's working.
that's what the world is. For every positive thing, there's somebody out there trying to backdoor it.
And Bob, there's so many people who unemployed, I'd never do anything illegal, but I've never been unemployed. I've never not had to worry about where my next dollar was coming from. So it's easy for me to say I would never do it, but I ain't never been in a position where I needed to do it. And so
Right.
I think things are tougher than people let on. That's just my humble opinion.
Right. So, though, ending on the stock thing, I just want to let people know I have a couple of stocks that I always tell y'all about, which is NXP, which is the competitor to NVIDIA, semiconductor chips and stuff like that. And they're up, they're up almost close to 300. And I only put $100 in a few years ago and it grew to that. And then the GE was at 70, and now GE is almost getting ready to head towards $400 a share. And just to let y'all know, these things happen. I always tell you about commodities, which is gold, because we like to talk about, having a very diverse portfolio. Gold is up again. Gold went down pretty considerably the past few weeks, but now it's back up to $4,416 an ounce, and it's only maybe a dollar more than last week. It's just been moving along slowly, but it got up to 4,400. And silver is tracking to
So,
silver.
hey Bob,
Mm-hmm.
gold got up to gold was actually 5,000.
Yes,
Yeah, gold got up over
it got
5,000.
over 5,000, and silver got over $100. So silver is now at 65, and it's up maybe a dollar or two too, but it usually tracks a little bit behind gold and silver.
Yeah, but
I've always,
one more thing, but I put in perspective. A year ago, gold was at 3,000, 3,200.
there you go.
It's up. That's 25%. It's up.
No, there you go. In 2017, gold was around about $600.
Right.
So it just tells you. I want to share with you because I always have a mutual fund I like to share with y'all. Now, we don't endorse any products, but I use the Fidelity. We like Vanguard too, but it's one whoever you want to choose. But Fidelity, I've been telling y'all tracking with this growth fund that Fidelity has, and it's up $600 today, and that's the up on the net asset. They call it net asset value. And just to give you some parameters, some measurements, 3 years ago it was at $43,000 that I had in it 3 years ago. Today is at $83,286. That's just 3 years ago. So you do the math, and it's a mutual fund, which means it's actively managed. So they charge it a little bit higher expense ratio than the index and exchange traded funds. But not telling you go out there, but just letting you know, tracking how these things work. It's it's not about time in the market. It's about time in the market.
And Bob, let's be clear here. The name of it is growth fund. Okay. And
Right.
by definition, that's going to be aggressive. Okay.
Right.
And the market has done tremendously over the last 3 years. So if you have been in a growth fund the last 3 years, you've done very well. On the other side of that is if the market goes down, it's going to go down just as fast as it went up. So again, we don't recommend that work for his portfolio. It may work for you. It may not work for you. But just understand when he says he's Fidelity Growth Fund, that's a very aggressive mutual fund. Okay.
Well, and actually, it's considered in the medium risk, believe it or not, though.
for growth funds. And by definition,
For growth fund. Yes.
growth funds are very aggressive.
Correct.
Very aggressive. So just be clear on that.
Right. Right. But it's all blue chip companies in it. The Magnificent Seven is in it, and even more, but mostly, no, all blue chip stocks are in it, and that makes it a little bit different too. The volatility is going to be a little bit different than if it was like what they call small cap or emerging companies just starting off. So, but yeah, no, just want to let y'all know that that's part of the risk, but we just want to let you know some of the products out there that we use. And there's other ones, like I said, there's Vanguard, there's T. Rowe Price, there's um, uh, Charles Schwab. So there's several different
E-Trade.
E-Trade, yeah. So, but we're just sharing with you all what we know, and just remember, past performance is no indication of future returns. Okay. Now, the cryptocurrency market it's down only 1% from last week. It's only down 13. That's $1 billion, by the way. It's at $2.2 trillion right now. The Bitcoin, which is the number one cryptocurrency, is down about $367. That's about 1%, but it's still holding there $63,414 a Bitcoin. Now, Ethereum, which is the smart contract, it's up $23. So I don't know what makes Ethereum go, but it is what they had called it a smart contract, where it's supposed to be a little bit more stable, a little bit more. I don't want to use the word secure than the Bitcoin. Then you have Tether, which is a stable coin, which is usually pegged to the dollar or some other assets, and they've been just staying at $99. But it's the volume that makes those move, right? But they had 99 cents. Then you have Binance, which is a lot of people follow Binance, and that's up, believe it or not, 7%, up $38. So I don't know, and it's in the fourth position. That is over 9,000, close to 10,000 cryptocurrencies that are active. There are over 40,000 cryptocurrencies, you all. You even have the Trump coin, which is definitely have crashed considerably. So those suckers fell into that. You have Ripple, which is at the number 6, and it's down by 7%. So that's the market, you all, and we just like to share that information with you. So you use that information accordingly. So let's get into today's show, which is beat inflation and build wealth.
Okay, Bob, and that's kind of this is one of those basic overview kind of things we're talking about. It's a good foundation if you're starting to invest. And we always talk about building long-term wealth, and there's tried and true ways to do it. And the first thing you have to do is recognize that inflation is always going to be a headwind to you. Always. It can reduce your purchasing power, and it can really have a negative effect on your total portfolio. So if you're investing for the long run, whether it's you're saving for retirement, or you're saving to buy a house, or whatever you're saving for, you got to protect your earnings from the corrosive effects of inflation. And one strategy that stands out from the rest, and that's owning stocks, owning equities, and staying invested. Markets are full of noise. You get volatility. You get, wars. You get national disasters, and all those things happen. And a lot of people get emotional when those things happen, and they bounce in and out, and they end up losing overall. But smart investors, the long-term investors, they keep it simple. They let it compound. They don't get caught up into all the little things that happens, and they invest in equities. And unlike cash or bonds, they give you ownership in the future. It's a chain of earnings, innovation, and productivity of a real company that you can build your base on to build wealth.
Wow, that's that's good information. So, there's like about two different fronts that you must, consider when it comes to beating inflation. You need to trim rising expenses now and make sure your investments has enough growth potential to outpace inflation over time. You need to understand where inflation hits you the hardest, right? Try to lock in on your costs. Like, if you can lock in on fixed, costs and fixed, interest rates, it's very important. And wherever possible, you got to keep emergency cash working for you. If you got emergency cash, it doesn't make sense to be holding it in a traditional savings account which pays less than 1%. Why not put it in a high option, a high yield savings account as an option instead of letting it sit idle? Build portfolios for growth potential as much as possible. Yes, you need to protect wealth, but you also need to build wealth, right? And a diversified mix of investments can help you, your buying power and keep you up with rising prices over time. So today we're going to discuss about 5 timeless principles that have been guided, that have guided successful investors to building wealth in inflationary times. And Dope is going to start us off today.
Yeah, well, and equities, they can do things that other items in the market can't. And if you aren't taking account of inflation, you're missing the boat, because it's a real threat to your earnings, to your wealth, the way it can beat up your purchasing power. And you hear the news and inflation's 3%, and what does that mean? If you think about over a decade or two, it can really beat up your earnings. And what that says is what you buy for $1 today, it may cost you $1.50 in the future. That's the ravages of inflation. So if your money isn't growing faster than inflation, you're going backwards. You're losing purchasing power. That $1 will not buy the same things in the future that it can buy today. And so if you are not keeping up with inflation, you're going backwards. Okay. And that's where equities come into play. They represent ownership in the company, real companies or businesses. And those businesses can fight inflation. They can raise prices. They can innovate and create new things. They can expand and grow. And over time, this growth translate into increased revenues and earnings, and ultimately share prices go up, and they typically can go up a little bit faster than inflation. A lot of companies also return cash to shareholders in the form of dividends, which again, that contributes to total return. It's like I tell you about Pfizer. The stock hasn't gone up very much, but I get a 7% dividend every year. So I make 7% just by owning Pfizer stock. So if you compare that to cash accounts or checking accounts or savings accounts at banks, they aren't keeping up with inflation, and your purchasing power year after year is going down. Same thing with bonds. They may offer stability, but they often fail to beat inflation. So equities may be volatile. We always talk about that in the short run, but over the long run, they've proven to be the most effective way to stay ahead of inflation and grow real wealth. So if you want your money to keep its value and grow in value over the long term, equities aren't a luxury. They're actually a necessity.
Oh, that's so cool though, because stocks is real companies, businesses that can raise their prices and improve productivity and innovate and expand over the time. This is where growth is realized, and that's how you raise revenues and earnings, and ultimately the price of your shares go up. That's just how it works. And the key is just trying to look at companies that are really operating very good. Next, I want to talk about never invest without a margin of safety. What does that mean? all investments carry a risk, but not all risks are equal. And one of the smartest ways to manage your risk is to buy with a margin of safety, like purchasing stocks and funds when the prices are reasonable or below its intrinsic value. Now, this doesn't mean waiting for a crash or trying to time the bottom, because even the top board money managers can't do that. It means focusing on companies, like I was just talking about, with strong, balance sheet, consistent earnings, competitive advantages, and sustainable growth over time. Buying their stock when it's not overpriced, right? That's why you look at the price earning ratio. For index investors, which we talked about the other week, it means continue to invest regularly, especially during times when the market has pullbacks, because the market always has pullbacks, which is also they consider like where it corrects itself, and sometimes the price drops, and that's the time to get in. Now, talking about the margin of safety, which acts as the buffer, if a market dips, you're less likely to suffer permanent losses, right? And if your instinct and research was right, you set yourself up for a solid long-term gain with a minimum amount of risk.
Yeah, got to know what your risk is. That's for sure. Now, and this is next principle we've told you about, and it's very, very important. Bob actually mentioned it at the beginning, and that's the fact that time in the market beats trying to time the market. And that's one of the biggest mistakes that people make, is thinking they can time the market, that they know when to get in, when to get out. And that's one of the big mistakes that investors can make. The market can rise and fall on headlines, interest rates, economic data, or sentiment, or things that may or may not be true. And we've shown you charts that shows that missing just a few days of the best performing days over a decade can have a massive impact on your overall return. And so you don't want to miss those days. After every downturn, there's been a very strong recovery period in the stock market. And so staying invested during turbulent times allows you to capture the full benefit of those recoveries. Okay. And historically, the market has recovered from every correction, every crash, every recession, every big event that's happened, from the pandemic to the tech bubble to whatever big correction has taken place. The market has recovered strongly right after. And those who stayed invested during those periods have eventually been rewarded. And those who jumped out at the first sight of trouble didn't do very well. And this is where dollar cost averaging comes into play. And we've told you about this, but just to give you a little refresher, what does that mean? That means investing consistently over time by regularly contributing to your portfolio, regardless of market conditions. You eliminate the need to try to guess when to get in, when to get out, since you're always participating in the market's long-term trajectory. The key is when you remain in the market, if the market's up, you're buying fewer shares, right? If you're investing $200 a month, and let's say you're buying a stock for $50, and the market goes up, or that stock price goes way up, or the market goes up, you're buying fewer shares at that point. When the market drops, you're buying more shares. So that's what dollar cost averaging is. Over the long term, you're going to do better than trying to guess when to get in and out. So you don't need perfect timing. And most people don't have it anyway. Nobody knows when to get in and get out. You can think you do, but professionals don't know. But consistent participation gives you long-term investing rewards. So the patient person who just invests over the long term is going to do okay, not the person guessing, trying to be lucky, trying to guess and time the market.
And there's a saying though, or insight that goes, Long-term investing rewards the patient, not the lucky. Now, I want to talk about this term you've heard many people say, get out your feelings, right? I want to talk about emotions when it comes to investing. Your emotions are the greatest risk when it comes to investing. When things are going well, investors feel invincible and they take more risks, right? When markets fall, fear takes over. They start believing in loss aversion. They worry about more what they can lose than what they can make. And many people sell at the worst popular time. This cycle of emotion investing is one of the biggest destroyers of wealth. A key to overcoming this investing blunder, this term is great. Emotional discipline. Oh boy, we need more of that. Having a clear investment plan and sticking to it regardless of short term market movements is the key. That is the critical part of emotional discipline. This means avoiding reactionary decisions based on fear, greed, and especially listening to the media and all the hype they be hyping up with things. It also means understanding that volatility is normal. That corrections are inevitable, like I talk about market corrections, pullbacks, and that downturns often provide opportunities for you to jump into the market. Now, here's a metaphor for you. View your portfolio like a farm. You don't sell a farm because of bad harvest season. You plant, water, and wait for things to turn around.
Hmm.
In the same way, successful investment means staying calm and rational when others are panicking. Now, the key insight for this is your behavior during downturns matter more than the downturn itself. The disciplined investor will always come out ahead.
Yeah. The next one is dividends and compounding. Those are the quiet engines of growth. And that's one of those things. If everybody, when they are young, could understand something as simple as the rule of 72s, I'm convinced it would have a profound effect on how you look at investing. And so a lot of people look at stock prices and they overlook one of the big components of long-term growth, and that's dividends. And I talked about it with Pfizer. And I said, okay, they pay a 7% dividend. Well, these regular payouts, they seem small in the beginning, but when they're reinvested, they contribute significantly to portfolio growth. So reinvested dividends allows you to buy more shares, which can then generate more dividends, creating a compounding effect that snowballs over time. And let's just use the example of Pfizer. So we're saying they're paying a 7% dividend, and we talk about the rule of 72s. What does that mean? That means you take the number 72, divide it by the interest rate, and that's how long it takes your money to double. Okay? So by that definition, the money in Pfizer should double about every 10 years. 72 divided by 7 is about 10. So every 10 years, your money should double. So if you got $100,000, in 10 years, you're going to have 200,000. In 20 years, you're going to have 400,000. In 30 years, you're going to have 800,000. So again, if you look at starting when you're young, putting your money away, and just think about that effect on your money, it's crazy not to want to save, not to want to invest, not to want to reinvest dividends. A lot of people get their dividends in a check, and now, regardless of whether you take it in check or you reinvest it, you still have to pay taxes on it because it's considered income. But the government gives you a break on dividend incomes. You only pay tax on, I think it's 80% of the total. If you put your money in a savings account, any interest you earn is taxed at ordinary income. Dividend income is given a tax break. Another reason to invest in dividend paying stocks. Okay. Some of the most successful long-term investors didn't get there by chasing fast growing stocks. They built their wealth by owning owning dividend-paying companies, and letting that compounding do the work. They just kept churning it back in, getting more shares, compounding, getting more shares and more dividends. So price appreciation may get all the attention, but dividends and compounding quietly build lasting wealth.
Now, all this information is good, but nobody's perfect, right? Nobody's perfect, but you must invest with patience, not trying to invest for perfection. The most successful investors aren't necessarily the ones with the highest IQ or even the most complex strategies. They're the ones who stay consistent, they think long term, and trust the process. They understand that markets will rise and fall, and that over decades, not over minutes, not over days, not over weeks, decades, that markets have an upward trajectory over time. The Standard and Poor's, um, over time since 1920 to today, has averaged 10% return. Now, here's a reminder to keep close. It's not about predicting the future, it's about preparing for it. And the best preparation is to, one, own high quality equities. Two, with those said, reinvest dividends because they compound too. Three, avoid emotional decisions. That is the killer to most investors. Most people are so afraid they don't even get into the market. Four, keep contributing. Got to be consistent and stay the course. Because at the end of the day, and we say this all the time, we can't say it enough, you all. Long term wealth doesn't come from time in the market, it comes from time in the market. With that, that brings us to the end of today's session. We like to thank everybody for tuning in once again. We love this. And remember, put some comments in the comment box if you are interested in some other information. There's something somebody might have told you about and you're not sure about. Please put it in the comment box. But as always, we like to thank you all for being with us. So with that, though, let's take it to today's summary and what are some of the takeaways about today's show.
First and foremost, you got to stay invested. Okay. You got to be in the market in order to make money over the long term. Can't be reacting. You got to stay invested, stay the course.
Inflation decreases purchasing power. For instance, if you're making a 10% return, the real return is inflation is somewhere around 3-4%. So you have to take that off the top. So you're really making 6%. So, and just think if you got a traditional savings account making less than 1% and inflation is at 4%, that means you losing purchasing power is taking you $3 more to purchase something. Inflation decreases your purchasing power.
Yeah, you got to know your risk tolerance. You got to know and understand the risk you're taking. And that way, that's going to help you stay the course. Because if you decide to pick something very risky, you know there's going to be ups and downs, but you're invested for the long term. You're not worried about the short-term fluctuations because you understand your risk and you understand the return you're expected to get because of that risk level you're taking. But you have to understand what your risk tolerance actually is.
And lastly, you must control your emotions. You must control, because a lot of people, make these, quick, knee-jerk decisions, or a lot of people just have unintended consequences because of their emotions. That's why one of the things we try to help you suggest to deal with your emotions, to take the emotions out, hire a qualified investment advisor. You know, that helps takes emotions out. That's why we say, seek help with people, a professional, preferred and licensed qualified investment advisor, and that takes a lot of emotions out. You know, not the end all, but definitely emotions is really has gotten a lot of people in deep debt and stressed out with their money.
And Bob, what it leads to is buying when everybody else is buying when things are going up, and selling when everybody else is selling when things are going down. Which
Right.
means you're buying high and selling low, which is
Yeah.
obviously the opposite of what you should be doing.
Yes. Yes. So just want to thank everybody. Roll call for being on. So this is how it goes, though. My sister Gloria stands for being glorious. My sister Nolia stands for no, she'll never leave you. My sister Linda stands for she'll always lend a hand. So we'd like to thank my wonderful sisters.
You don't have no brothers, man.
What'd you say?
Do you have any brothers?
I have two brothers, Steve and Arthur.
You don't never mention them.
Yeah, because our men are, we think I don't know, we don't trust people more than women. But yeah, Arthur's in Charleston, and
South Carolina?
yeah, he's in Charleston. Yep, South
Oh,
Carolina.
wow,
He's the
okay.
only one out of the city. Steve is he's in Washington D.C. But yeah, like thank now, Dodie. Thank you very much. Hey, Rodney, thank you for being Rodney. Just chipped in and said, look, I forgot to say good evening. I'm here, y'all. Been listening all day. Thank you, Rodney, for that. You are the greatest, my good brother. And Carl Chapman, what's up, my brother? Love you much, man. Thank you for tuning in as always. Thank you for all other people who we know that you're on, but you didn't want to identify yourself. Because a lot of my friends tell me they were on. I'm like, what? They say, yeah, I just don't want to be identify yourself. But thank you all for being on. And Doe,
Yes,
a
sir.
wonderful quote for this week. Check this one out, though. I hope you can follow this one. Your future is shaped by the habits you repeat, not the goals you set.
Yes, that's cool. I like that.
Yeah, you can set goals, but if you don't have good habits, man, they can just go. But anyway, I made that up, by the way, though. So
Did you really?
personal. No, I'm lying.
I was gonna say that's pretty good. Either way, it's a good one to remember.
So look, thank everybody for being on. We really appreciate y'all. Yeah, dope.
We won't be here next week.
Oh, right. Because this is in our vacation zone, you all. And so me and Dope, we were doing the show when we went on vacations, but we realized that really wasn't fair to our children and spouses when we go out, and not even ourselves, even though we wanted to make sure we didn't want to miss anything. But thank you all for letting us be able to take a day off or so. But we're going to come back the week after that with the FiTT Show. Financial information for today tomorrow. Please remember, you all, to share on Facebook and to subscribe on YouTube. Come on, share this information with people. By the way, we still growing. We're over 500 followers now, though. So
Cool.
we're still picking up new people. So once again, we thank you from the bottom of our hearts and have a wonderful rest of the week.